Welcome to Standard & Poor's Loan Market Overview. I'm Steve Miller, a member of Standard & Poor's Leverage Commentary and Data Team, a unit unaffiliated with S&P Ratings. For the next few minutes, I'll walk you through an overview of recent loan market trends before winding up with some themes to watch for in April. For up-to-the-minute updates on the loan market, please follow us on Twitter, Facebook, and LinkedIn. You've all seen this before. It's a disclaimer that's long and quite detailed. Please read it at your leisure. Now to the topic at hand. In March, the loan market shook off pig-related concerns. The S&P LSTA index gained 2.3% after eking out a 30 basis point increase in February. With demand running strong, signs of recovery and rehabilitation abound. New issue volume climbed to a post-Lehman high of $42 billion in the first quarter from an average of just $20 billion a quarter last year. First quarter activity was concentrated in refinancings and recapitalizations, while mergers and acquisition-related volume lagged. Leveraged buyouts in particular have yet to take off. The market appears to be caught in a particularly deal-unfriendly part of the cycle. On the one hand, purchase multiples have run up enough to render most situations no longer cheap, but on the other hand, values have yet to reach levels that capture the imagination of sellers. LBO activity has therefore been a sideshow so far this year, with most activity focused on self-help deals in the form of amend-to-extend transactions, bond takeouts, and covenant relief. All told, issuers executed $71 billion of such transactions in the first quarter, and in the process extinguished another $31 billion of loan maturities. Technical conditions were bolstered again in March by strong repayment rates. As well, money continued to flow into the loan mutual funds at a rate of roughly $200 million a week, according to Lipper FMI. Improving fundamentals were seen in the default rate, which plunged to a 13-month low of 5.8% in March. As well, the pace at which S&P is downgrading loan issuers into CCC ratings has fallen below 1% in 2010 from 3 to 5% last year. The big new theme of the first quarter was dividend financing. Private equity firms used strong credit market conditions to issue $8.5 billion of loans and bonds to pay dividends. The issuers in question were mostly those that had done well enough during the recession to delever their balance sheets. Therefore, the pro forma debt multiples of dividend deals was modest at 4.3 times, which is about a half a turn inside the overall average. This chart shows the average price of LCD's Flow Name Composite, a measure of the 15 largest, most liquid loans. In March, the composite climbed to a two-year high of 95 in response to muscular technical conditions and a run of better-than-expected earnings reports. Here's that same composite for just the first 3 months of 2010. The main takeaway here is how stable prices have been this year relative to the turbulence of 2008 and 2009. The market's been insulated, so far this year at least, by strong demand and falling default rates. This chart displays the monthly return of S&P LSTA Index, a broad measure of loan market returns that we calculate in partnership with the Loan Syndications and Trading Association. The market put a 2.3% gain on the boards in March, bringing the year-to-date increase to 4.6%. The index now sits at an all-time high, and even excluding accrued interest, the price of index loans are up to a 26-month high. Now we turn to market technicals. The graph to the left illustrates new issue volume. As impressive as the increase has been, repayments have been even more so, bolstered as they were by $13 billion of bond takeouts. As the chart on the right shows, the universe of outstanding loans contracted another 3% in the first quarter to $514 billion. What's more, investors poured another $2.8 billion into loan mutual funds, according to Lipper. This combination of repayments and inflows pushed loan prices higher in March, as we saw in the previous chart. It wasn't just supportive technical conditions that drove loan prices higher in the first quarter. The market also benefited from improving fundamentals. This chart gives a classic view of loan default rates. It does so by dividing the amount of defaults in any given 12-month period by the amount outstanding when the period began to give a trend line. After spiking in 2009, default rates have come down just as quickly, dropping from an all-time high of 10.6% in November 2009 to 5.8% as of March. The reason is threefold. First, many of the weakest issuers in the most troubled sectors have already been claimed by bankruptcy. Second, nearly 2 in 5 issuers have executed either an amend to extend, a bond for loan takeout, or a covenant relief amendment that at the very least has pushed out the date of reckoning for several years. Third, and most important, issuers' earnings are again climbing. Among S&P LSTA issuers that file publicly, EBITDA was up 15% on average in the fourth quarter. Managers say that improvement continued in the first quarter, and most believe that default rates will drop to 2 to 5% by year end. Some accounts worry, however, about a second spike in 2011 or 2012 if economic growth peters out and issuers are not able to refinance a still formidable 2013 and 2014 maturity cliffs. S&P's chief economist David Weiss is more sanguine, however, predicting that American GDP will grow by 2.1% in 2010 and 2.2% next year, which should support further declines in default rates. To wrap up, then, some final points. First, loan volume seems poised to pick up in April. LCD's forward calendar ended March at a post-Lehman bankruptcy high of $20 billion. Even excluding refinancings, there was $14 billion in the offing. Next, in the first quarter, issuers managed to pay off or push off $31 billion of maturities through amend to extends or bond takeouts. Players expect no slowdown in these sorts of self-help deals as the second quarter unfolds, if, of course, the credit markets remain hot. Third, some deals will likely push against the edge of the envelope. Arrangers expect some 6 times debt multiple deals to test the market in the second quarter, but continue to expect the center of gravity to remain in the mid-5 times range. Moreover, Lyondell's successful covenant-light exit loan may open the door for more incurrence test-only deals, though participants expect most loans to continue to include 2 to 3 financial covenants. Fourth, managers report that more investors are looking to the loan market as a potential hedge against rate increases. That strategy has benefited from better economic numbers as well as falling default rates. Fifth, March brought the first 2010 CLO print, a $525 million vehicle from collateral manager Frazier Sullivan. The deal increased and refinanced an existing CLO. Participants expect Frazier's success to bring forth more refinancing deals as well as at least a few de novo transactions. Optimism for the moment is running stronger for refinancing existing deals than for brand new transactions. The issue for new deals remains thin arbitrage between the spreads of collateral and liabilities. Finally, participants expect the first quarter stability to persist into April and probably for the rest of the year, with strong technicals and improving fundamentals providing some insulation against exogenous shocks. That brings us to the end of our presentation. I hope you found it informative. For more information on the loan market, you can check in with us on the web or via LinkedIn, Twitter, or Facebook. The links for each of these is in the description of the video. Also, check back here on our YouTube channel for monthly loan market updates as well as other market clips.